Welcome to the Global Wellness HQ family of podcasts. We are your international headquarters for resources and ideas and insight in relation to the 9 elements of holistic wellness. Join us as we interview local and international wellness experts and learn how you can implement and improve one element or dimension of wellness at a time. Our experts will share their practical tips on wellness in one of these core areas: emotional, intellectual, occupational, physical, environmental, financial, spiritual, social, or habitual. We created our family of podcasts as a resource for anyone who is looking to integrate the 9 elements of holistic wellness into their daily lives. Welcome to the show.
Hi, everyone. Welcome back to Cash Flow Club. In today's episode, I'm going to talk about financial statements again. And today, specifically, we're going to talk about the income statement. And this little graphic is from investing.com, and it's really, really simple. We have our total revenue, less cost of goods sold, less operating expenses, less non-operating expenses, less taxes equals net income. And I'm going to just walk you through this because there's a few things here that I think might be important. So first and foremost, under revenues, in this case, and this can also be called a statement of operations. I'm going to call it an income statement. You might also hear it called a profit and loss. Or statement of profit and loss. This is the second most important financial statement. And what this does is it shows think of it like a video because it shows results for the period. So in this case, you can see here it's for the year ended September 25th, 2021. Now, just your year end is going to be different. You might have for the month ended, you might have it for the week ended. But basically, it shows the snapshot. So it shows a video of the year. So these are all the activities that happened in the time period indicated up here. So again, this is for a fiscal year. You might have it for a quarter. You might have it for a month. You need to first of all understand what period is being covered. So in this case, this example, this is for a full year. And now they use the term net sales. Some people use the term gross revenues. What this tells me is that in products or services, if there's any discounts or refunds, that's probably lumped in and netted against sales. So the first metric I always look at for a business is what's their total revenue. And in this case, you want to look at what's the trend. So you can see revenue went up a little bit and then it went up a significant amount. So we want to figure out what's driving that revenue increase. And just to be clear, a dollar of revenue is not always equal because it depends entirely on the cost to deliver that, which is where we get the cost of sales. So in this case, we can also see that cost of sales increased, and that's because for every dollar that we sell, there's some percentage that comes in as an expense. So in the case of products, if you're buying goods for resale, the cost of the goods that you sold becomes a reduction here. If you have services, it's usually labor. You hire an employee to deliver the service. That's how we get the cost of sales on our services. So if we don't have a strong gross margin, in this case, it went up significantly year on year. A good, strong gross margin tells us that we're selling our goods, our products or services at a margin where we're making some money. So that's the first place. I actually worked with one professional service firm. They had labor costs in excess of their revenues. Therefore, their gross margin was negative. They were losing money right out of the gate. So the first thing we had to do was we had to fix their revenue, and then we had to revisit their labor costs because they were paying higher than industry average and charging less than industry average. So in the end, they were losing money before they even got to their overhead. So we want to make sure gross margin, that's the number that determines, how we pay our overhead, things like that. Um, and that's why a dollar saved, if we can reduce our expenses by a dollar, we save a dollar in our bank account. So a dollar reduction in expenses saves us a dollar. Whereas if we earn an extra dollar, we're not necessarily going to keep an extra dollar because we have to pay our overhead, our cost of sales, our operating expenses, things like that. Now, gross margin is what we have left after revenue, less the direct costs. And like I said, that can include labor, it can include materials, it can include construction, it can include assembly, it can include labor to assemble materials, it can include shipping, things like that. So basically, what's the cost to get your inventory to your selling place, whether it's a store or a warehouse, so that the customer can start buying it? Now, under operating expenses, this example is pretty light, but basically the operating expenses can be fixed or variable. And short-term, basically variable expenses, we can change them in the short term. Things like office supplies, if we are short on cash, we can say, okay, we're not buying any more office supplies this month. We'll use up the last of the letterhead. So variable expenses, those are the things that we can sort of turn them off and on as we need to. Fixed expenses are things like rent, utilities. They're not variable within a year. So fixed expenses, we're kind of stuck with them in the short term. Long term, everything becomes variable. For example, rent is fixed over the term of a lease. At the end of the lease, you can renegotiate, or you can find cheaper premises, or you can spend more. So we want to be clear on which of our expenses are in fact fixed. We want to optimize those. We want to budget for them. We need to make sure we've got revenue to cover our fixed expenses. We also need to make sure we have revenue to cover our variable expenses. And that gives us our operating income. Now, we might have interest expenses. If we've got long-term debt, we might have some other things. And then we always need to make a provision for income taxes so that we're paying our taxes. Now they've just lumped selling, general, and administrative expenses together. Again, a good income statement, you're going to have as much detail as you need so that you can analyze it. This is a summary report, not a detailed report. One of the things I do with my clients is we'll look at your year to year variances, and that's a good way to determine, are we more successful than last year? Are we making more money? Are we spending more? Where can we reduce? Where should we increase? So this is just the basic income statement, and we talk about income taxes as a goal. You want to pay as much as legally required, but no more. So we want to look at tax minimization, legal tax avoidance. We don't want to get into tax evasion. That's illegal. So this is how we look at the income statement. And basically the big thing I want to say about this particular statement, this looks like it's from a publicly traded company. So we're not seeing owners' compensation in terms of a salary to the owner. So first things first, when you're looking at your income statement, you're looking at the balance sheet, you're looking at the financials in general. Is the company paying a return to the shareholder, the owner, the investor? And if not, then we need to question how long that business can keep going, because if the owner is not receiving any compensation, it might be an indication that the company is not as viably sound as it looks. So for example, in this case, there is net income, but if the owner needs $100,000 a year to survive, and they haven't been paid, you can see we don't have enough money in any of those 3 years to pay the owner. So that's going to cause the owner to dip into savings or to have to find other ways to bring in cash. So as the owner, you want to make sure you're being paid, you're receiving a good return on investment. And one of the little tricks we do, and I'll share this with you, is you can turn your income statement into a percentage and basically make everything a percentage of total net sales. So this number would be 100%. This number's like probably 80%. This is somewhere around 20%, give or take. But basically, we can look at our expenses as a percentage of sales. And that's going to give us a clue as to the ones, the bigger they are as a percentage of sales, those are our bigger relative expenses. Maybe we can find ways to reduce them. So that's the income statement. There is a lot of analysis we can do. I just wanted to give you a high level of what you're looking at on the income statement. And the last thing I'll point out is that net income is not going to necessarily reflect the cash balance in your bank account, because you might sell some of your goods or services on credit and maybe you haven't collected that. Or the other side, you might pay some of your expenses on credit, or you might have credit to cover some of your expenses. So the cash hasn't gone out yet. The cash doesn't go out until you actually pay it, but we recognize and record the expense at the moment it's incurred. The other big variable is investing. If you're putting money into the stock market, that's money that comes out of your cash account. Or if you're paying off long-term debt, that's money that goes out, but it won't show up on the income statement. So I hope that gives you a little bit of a context for the income statement, and I look forward to questions.
Thank you for taking the time to listen to our show. We hope that you enjoyed this episode, and we invite you to either click the link below or scan the QR code to register and listen to other episodes of our podcast. Or if you think your business or you would be a great guest to be on our show, we're always looking for experts in one of the 9 elements of holistic wellness. We'd love to have you. You can either click the link below or you can scan the QR code and complete our speaker intake form. Thank you, and to your wellness.